All right, what's up, guys? I hope your weekend is going well. Obviously, market's closed right now. Um, we had rate cuts, right? Like I said, if there's rate cuts are highly correlated with market crashes. Okay, I'm usually a perma bull, but there are a few things that can occur in the markets where there is a high probability of a crash. Okay, and one of those things is rate cuts. Rate cuts are correlated, they either precede or come right after. Sorry, let me rephrase that. Rate cuts usually happen right before or during a market crash. Meaning, sometimes they cut rates and the market keeps going up a little bit longer for a couple more months and then it crashes. Okay, but if you look at the history during the Great Depression in 1929 to 1933, rate cuts happened simultaneously with the crash. Okay, crash of '87, I believe rate cuts had happened pretty close to that in time. At some point during the same year, there were rate cuts. The dot-com crash in the early 2000s, rate cuts. The financial, they call it the Great Recession, the financial housing crisis of 2008, rate cuts. Even the COVID crash in 2020, now that crash was caused by COVID, but rate cuts occurred at the same time. They brought interest rates down to zero as the market was crashing. Interest rates hit zero, they can't go any lower, right? Or they could, but the Federal Reserve is not going to give negative interest rates. That would be extremely strange. But anyway, basically, but then rates bottomed out, and then once they couldn't go any lower, pretty much, market goes up, right? And so, my theory for it is that when rates start getting cut, people tend to, I believe, they pay off a lot of their loans, which sounds weird, right? Why would they be paying off loans as rates are going down? Well, here's the kicker. They pay off as much as they can before rates hit a bottom. They sit on their cash, maybe collect interest on it. Once rates hit a bottom, get close to 0%, 1%, then they take out new secured loans at those lower rates and get locked in at a fixed rate loan or whatever they're doing, fixed rate credit, fixed rate loan. They'll secure the loan against their assets. I'm talking about this is what the rich people do, and then they're locked in at a fixed rate so that they could, take a secured loan against their house, invest all of the loan into the S&P 500 or the Nasdaq 100 at a 1% fixed interest rate, for the next 10 years or whatever. They're locked in at that rate, or next 5-6 years, whatever. They lock in at 1%, and so they are paying a little bit of interest, but the average return of, like, the Nasdaq, for example, is like, what, 10% a year? So, I mean, they're going to get 9% a year, okay? But they're basically going to get it for free because they just took out a secured loan against their house and locked in. So people, in anticipation of rates eventually bottoming out, they pay off their debt, and then they re-incur debt at a lower interest rate. And then the market starts pumping again. Again, I'm not a master's at this stuff. I didn't go to school for it, but to me that seems like the reason why rate cuts and recessions happen simultaneously, and why the market actually tends to go up while interest rates go up. Or if interest rates are already at a low and they can't go any lower, that means they eventually will go up. And the same thing, the market goes up in anticipation of higher interest rates. So I think the idea is that people are getting interest rates at a premium or a discount. And so when interest rates are heading towards a discount, people are waiting to try to buy them at their lowest. And when interest rates are going to a premium, people are trying to wait to offload them at their highest. Yeah. So, however, market since rate cuts, market has actually shown some willingness to be kind of bullish. Not exactly, but it's just not like ripping down. And my theory for that is that they cut rates very sharply. I think at the next rate decision is probably when the market will actually start crashing. And I think that's when. That's November, right? So I think in November, you would expect right around the next federal funds rate decision for the market to start crashing. Whether they hold the rates the same or they drop it another 25 basis points, I would expect the market to start crashing around then. But then again, what do I know? The market could just decide to keep going up. We all know from what I've said previously that in the long run, that's what it will do, as so long as inflation continues, so long as currency supply is increased by the government just printing money out of thin air, so long as a large amount of debt just gets defaulted on, and it just, that money, that credit never gets destroyed by an equal amount of debit, inflation will continue, and inflation will drive up prices of not inflation adjusted stocks, right? So in the long run, it will go up. But like knowing the occasional recession that tends to happen every 6 or so years, sometimes more frequently, but usually less frequently, knowing when those things are going to happen can actually can have a significant impact on your profit factor. If you can occasionally time the market, your profit factor will go up by like 5-fold. And what I mean by that is being generally a permeable. However, knowing when the writing on the wall says, hey, there's going to be a crash this year, or hey, it's going to crash, if you can know that, and you can sell your positions at a premium and get back into them after the crash has happened for 6 to 12 months, 6 months, 12 months into a crash, you start accumulating your long-term positions in those same stocks just at a discount. Can have a huge impact on your gains. Also, if you can short the market when that crash happens too, again, even bigger compounding effect on your profit factor. Now, obviously, they say hogs get slaughtered, so it's not an easy game to play, but at the same time, it's not too difficult. I pretty much gave away one of the key flags of a recession or depression or market crash is rate cuts. So, hey, I'm just throwing it out there. All right, I can't promise that the market is going to crash. It already crashed in 2022, so it crashed pretty recently. Not to mention, actually, this summer, this crash here was actually pretty significant too. If you want me to show you how significant it was, I can, if I could just remember which tool does that. I think it's this. So the NASDAQ already from high to low lost 17% this year during this crash. That is a crash. I mean, I know 20% is recession, quote unquote, but 17% is like, that's enough for mean reversion to occur, and then it starts going up, right? Which it did after that. However, that doesn't mean that whatever is going on here is over, because this was before the rate cuts. This was in anticipation of rate cuts, and it started selling off already, right? Maybe now that's priced in, which is why I'm saying next rate cut or next federal funds rate decision, whatever they do, so long as they don't increase interest rates again, if they keep them the same or decrease them, I think that to Wall Street that looks like, hey, rates are going to be in a downtrend. Like they are going to continue cutting rates at some rate of speed. Even if they don't cut them that time, they'll anticipate a few more basis point rate cuts, next year. I think the market would sell off. But anyway, that's just my conjecture. The video is about to be 10 minutes, so I think that's probably a good amount of time to wrap it up. But yeah, I think we actually could see a pretty sizable crash before the year's up, which is unfortunate if you ask me, because I make the most money when the Nasdaq's in a bull market. But hey, just note, being aware of a rat crash being able to happen, could save you a lot of money. So anyway, take care, guys, and I'll see you next time.